Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today we're looking at AN2 Therapeutics.
If you find our talks useful, please consider subscribe, like, and comment underneath. And let's just unpack this right away.
Let's do it.
Because if you are serious about building wealth in the modern market, you already know that clinical stage biopharmaceutical plays offer some of the most the most asymmetric risk to reward profiles out there.
Oh, absolutely. It is a high-stakes arena.
Right. High stakes, high reward. It's definitely not for the faint of heart.
Oh, it really isn't.
So our mission today is to evaluate AN2 Therapeutics from absolutely every angle. We want to give you a clear, actionable picture of what's going on here.
Yeah, we're going to look under the hood at their core technology, dissect the rather stark financial realities of their balance sheet, and analyze this incredibly surging market momentum we've been seeing.
Exactly. And map out the catalyst calendar, too. The goal is to give you a comprehensive wealth-building thesis so you can make informed decisions.
Which is crucial in biotech.
Right. Let's start right at the foundation. Every great company needs a competitive moat. And for AN2 Therapeutics, that moat is their proprietary boron chemistry platform.
Yes.
But to truly grasp the investment potential here, we really need to understand the science. I mean, how does a boron-based molecule actually behave differently than the traditional drugs we're used to?
Well, to really understand why this matters for your portfolio, you kind of have to look at how drug discovery has historically worked.
Okay.
In the pharmaceutical world, standard carbon-based molecules are the absolute norm. Carbon is fantastic because it forms these very stable, predictable structures. Think of carbon atoms like standard Lego bricks.
Right, you can build almost anything with them.
Exactly. But finding new treatments for highly resistant, really hard to treat infections, using those traditional carbon Legos is getting incredibly difficult.
Because the bacteria adapts.
Exactly. The bacteria and parasites have evolved. They've figured out how to block those standard shapes. But boron is fundamentally different.
How so?
It has a totally unique atomic structure. It has an empty orbital, which means it can actually form reversible bonds with biological targets.
Yeah. So instead of a rigid Lego brick, it's something much more adaptable.
Yes. Think of their boron platform as a highly specialized skeleton key. Because of that unique chemical flexibility, it allows them to design novel, small molecule therapeutics that can reach and interact with targets in ways that traditional carbon-based drugs simply cannot.
It opens molecular locks that have just stayed stubbornly shut.
Exactly. For decades, Big Pharma actually shied away from boron because early attempts were notoriously difficult to stabilize.
Oh, really?
Yeah. But AN2 Therapeutics has cracked that code.
Yeah.
They turned a historical chemical challenge into a highly defensible proprietary platform.
Wow. You know, you mentioned Chagas disease earlier when we were reviewing the pipeline before the show.
Yes.
I know that's a notoriously tough one to crack. It's often called a silent killer because it can literally hide in the body for decades.
It's awful.
Do we have any actual data on how this boron platform is performing against it?
We do, and honestly, the numbers are genuinely staggering.
Okay, let's hear it.
So, Chagas is caused by a parasite that burrows into heart and digestive muscle tissue. Traditional treatments have severe toxic side effects.
Right.
And they often fail once the disease reaches the chronic stage. But when they tested their boron-based candidate in non-human primate models,
Yeah.
it achieved a 100% survival rate.
Wait, 100%?
100%.
Oh.
It completely outperformed the existing benchmark agents developed by legacy pharmaceutical companies.
That is wild.
When you see a 100% survival rate in primate models, you aren't just looking at some incremental single-digit improvement in efficacy. You're looking at a potential paradigm shift in how we treat complex parasitic infections.
That is a massive data point for anyone evaluating the underlying technology. But, let's look at the broader market perception here. Promising lab data is one thing.
Sure.
Getting a drug through the regulatory gauntlet requires deep pockets and serious industry muscle.
Takes a village, yeah.
Is the broader medical community, or more importantly, the large institutional players, are they actually recognizing this breakthrough?
They absolutely are.
Yeah.
And you don't have to just take the company's internal press releases at face value here. Look at the third-party validation.
Which is always the gold standard.
Exactly. AN2 Therapeutics has secured a heavy-hitting collaboration with GSK.
Wow.
Yeah, which is one of the largest and most well-resourced pharmaceutical companies on the planet. They are working together on boron-based tuberculosis inhibitors.
That's huge.
And what makes this even more compelling is that this specific research is being funded by the Gates Foundation.
Which is a massive signal. I mean, the Gates Foundation does not just throw money at speculative science fair projects.
No, they don't.
They employ some of the strictest scientific due diligence teams in the world. They fund initiatives that have a very high probability of fundamentally changing global health outcomes.
And that is the crucial takeaway for you as an investor listening to this. This kind of institutional validation builds a formidable defensive moat around AN2 Therapeutics intellectual property.
Right, because when players like GSK and the Gates Foundation are effectively underwriting your core tech.
It signals to the rest of the market that the underlying boron platform is highly credible. It serves as a huge deterrent to competitors who might try to muscle into the boron space. The heaviest hitters have already chosen their partner.
Okay, so the science is incredibly promising, and the institutional validation is clearly there. But if you're evaluating this as a wealth-building vehicle, we have to talk about the financial reality.
Let's do it.
We need to look at the health and the earnings of the company today. I'm going to plainly state the current financial picture so you know exactly what you are looking at.
Lay it out.
AN2 Therapeutics is a clinical stage biotech company, which means they currently have zero revenue.
Right. Zero.
None. And looking at their trailing 12-month net income, the company is operating at a loss of $51.3 million.
Yeah.
And the diluted earnings per share sits at negative $1.72. Now, for a traditional value investor who looks for steady dividends and low price-to-earnings ratios, those numbers might induce immediate panic.
That is a very fair assessment. But in the biotech sector, you have to completely reframe how you look at those losses.
How so?
You have to ask yourself, what are they actually spending that $51.3 million on?
Yeah?
These negative earnings are entirely typical research and development investments.
It's the cost of doing business.
Exactly. In this industry, you are essentially building a highly specialized, intensely regulated, multi-million-dollar factory before you are legally allowed to sell a single product. The cash burn is just the price of admission.
Right, but the market isn't flying blind here either. A burn rate is really only a problem if you run out of fuel.
Precisely.
So we have to look at how they're financing this operation, which brings us to their recent capital infusion. They just executed a $40 million private placement.
Yes, they did.
But hold on, adding $40 million through a private placement means issuing millions of new shares. Doesn't that just dilute the existing shareholders?
It does introduce dilution, which is always a headwind. Specifically, over 8.2 million shares were sold at $2.85 per share.
Okay.
But the mechanics of a private placement, or a PIPE, as it's often called, are critical for you to understand here.
Why do a PIPE instead of a regular public offering?
Because it brings in strategic partners quickly. The most important part of this deal isn't just the $40 million, it's who wrote the checks.
Right.
This placement was led by institutional heavyweights. We're talking Coastlands, Commodore, and Vivo Capital.
So the smart money is stepping in.
Exactly. When institutional funds of that caliber lock up $40 million at $2.85 a share, they aren't day trading the stock on their phone.
No, they're not.
They have deployed teams of PhDs to conduct deep due diligence on the clinical pipeline, and they believe the long-term payoff absolutely dwarfs the short-term cash burn.
That makes sense.
And this capital infusion significantly bolsters their liquidity. It essentially secures their cash runway for near-term R&D without the immediate threat of further capital raises hanging over everyday shareholders.
That's a great point. And despite the fact that no profitability is expected over the next 3 years, which, again, par for the course in clinical stage biotech sentiment among the analysts covering the stock, is noticeably shifting.
It really is.
Wall Street is starting to pay very close attention to the trajectory. Analysts are now forecasting an annual earnings per share growth of 15.7%.
That's solid.
Yeah. While the fiscal year 2025 consensus earnings per share sits at negative $1.12, those estimates have actually risen 5.2% in just the last 3 months.
Right.
So the company's still losing money, but the trajectory of the loss is steadily improving.
And that upward revision trend is exactly what quantitative models look for.
Interesting.
In fact, this specific trend of improving earnings estimates recently triggered Zacks to upgrade the stock to a rank number 2 buy.
Wow, a rank number 2 buy for a pre-revenue biotech.
Yes, it's a substantial signal. It means the fundamental financial picture, relative to their secured cash runway and clinical progress, has fundamentally de-risked in the eyes of the analysts.
The financial foundation is stabilizing just as the science is accelerating.
Precisely.
So we have the validated science and we have the strategic capital. Now let's talk about what happens when those two things collide on the open market. Let's look at the surging momentum and the price action.
The charts are fascinating right
They
now.
really are. If you've been watching the charts, you've seen a staggering rebound. The stock has posted a 377.27% total change,
Incredible.
representing a significant recovery from its recent downtrend. It's carving out higher highs and aggressively capturing trader attention. What are the technical indicators telling us right now?
From a technical analysis standpoint, the indicators are remarkably bullish. If you look at the moving averages, the 20-day simple moving average has crossed above the 60-day simple moving average.
It's a big deal.
It is. For those newer to chart reading, that is what traders refer to as a golden cross.
The golden cross.
Yes, it is a classic technical signal that indicates short-term momentum is accelerating past the long-term trend. It shows that buyers are stepping in at higher and higher prices, establishing a new floor.
And algorithmic models love that.
Oh, they do.
Yeah.
It's no surprise that Intellectia AI has rated the stock a strong buy based squarely on these positive momentum signals and the rising trend structure.
You know, the volume surge backing up this price action is what really stands out to me.
Yeah, the volume is massive.
We're seeing an average turnover of over 65.3 million shares over a recent 5-day stretch. High volume validates a price move. It tells you this isn't just a fluke.
Definitely not a fluke.
You don't get 65 million shares trading hands just from retail investors logging into their brokerage apps. That is serious institutional machinery moving capital into the stock.
It really is. And for your trading strategy, mapping out the technical boundaries is vital here.
Okay, what are the boundaries?
Based on the current setup, the potential breakout resistance sits up between $6.87 and $9.11.
Got it.
That is your upside friction zone, where early buyers might take some profits. On the flip side, algorithmic models indicate downside support is remarkably tight.
How tight are we talking?
Well, the algorithms are actually mapping downside support in negative numbers, between negative $0.41 and negative $2.65.
Wait, which sounds crazy for a stock price. You can't have a negatively priced stock.
Right, it is a statistical anomaly resulting from the extreme recent volatility and the low price base. But it is incredibly revealing.
Oh, so?
It basically tells us the mathematical models see the downside risk as heavily constrained right now compared to the upside breakout potential. The floor is really solidifying.
And to back up that idea of a solidifying floor, look at the institutional accumulation. There has been a 30.38% increase in institutional transactions over just the last 3 months.
They are loading up.
The big players are accumulating shares rapidly. Furthermore, the short float is sitting at an extremely low 0.34%. What does a short float under 1% actually signify in a volatile sector like this?
That low short float is one of the most critical data points we have. Short sellers borrow shares and sell them, betting the price will drop.
Right.
When institutional accumulation is up over 30% and the short float is practically zero, it tells you that the broader market has fully accepted the underlying value proposition.
They aren't trying to fight the trend.
Not at all. Despite the historic volatility of this stock, bearish pressure is virtually non-existent. Short sellers are essentially unwilling to bet against this momentum right now. The smart money is positioning for future growth, not betting on a collapse.
Which perfectly transitions us into what that future actually looks like. Let's talk about the catalyst calendar and future speculation. Why is all this money flowing in right now?
Imminent milestones.
Exactly. The biggest near-term event that you need to have circled on your calendar is the advancement of their oral drug, epetraborole, into phase 2 clinical trials.
And the target of this phase 2 trial represents a monumental shift for the company's valuation potential.
Talk to us about that.
Well, up until now, we've talked about infectious diseases like Chagas and tuberculosis.
Right.
But they are evaluating epetraborole for phlebotomy-dependent polycythemia vera.
Okay, that is a mouthful. What exactly is that?
Polycythemia vera, or PV, is a specific type of blood cancer characterized by the dangerous overproduction of red blood cells. Think of it like a severe traffic jam in your veins.
Oh, wow.
The blood gets too thick, which can lead to catastrophic cardiovascular events like strokes or heart attacks. And the current standard of care often involves frequent blood draws, literally draining the thick blood, or using older, harsh chemotherapy like drugs.
So an oral targeted boron-based drug would completely disrupt that standard of care.
Completely.
And moving into PV marks a massive expansion of their platform. They are pivoting from infectious diseases, which are vital for global health but sometimes command lower profit margins, straight into the highly lucrative oncology space.
That pivot is the defining factor for the current momentum. The market multiples for oncology drugs are staggering compared to infectious disease. If their boron chemistry can safely and effectively treat blood cancer, the valuation ceiling on this company completely changes.
That is a game changer.
Yeah.
And alongside that phase 2 initiation, you've got the expected Q1 2026 earnings report coming up.
Yes.
The consensus earnings per share for that report is negative $0.24, but as we discussed earlier, those estimates are trending upward. You should also be watching for upcoming clinical updates from the GSK collaboration regarding the treatments for melioidosis and tuberculosis.
Yeah, there are multiple irons in the fire here.
For sure.
We also have to view this through the lens of the broader macroeconomic picture, because the timing is incredibly favorable right now.
Macro tailwinds.
Big time. We are seeing major macro tailwinds. There are significant biotech sector rotations happening, mostly driven by rate cut expectations.
Right, because when interest rates drop, borrowing costs fall.
Exactly. And institutional capital flows out of safe, low-yield assets and aggressively into high-growth, risk-on sectors like clinical-stage biotech.
It makes perfect sense.
Additionally, government funding trends are aligning perfectly with AN2 Therapeutics' focus on biothreats like melioidosis. Global health security has become a paramount priority for governments worldwide, and substantial non-dilutive funding is flowing toward novel solutions.
And you can't talk about a surging biotech stock expanding into oncology without addressing the industry rumors.
Oh, the rumor mill is definitely churning.
There is unconfirmed speculative chatter in the market that a strong phase 2 readout for their PV blood cancer trial could easily attract major biopharma buyout or partnership interest.
I wouldn't be surprised.
When a platform proves it can tackle infectious disease A&D oncology, the industry giants start circling.
That is the ultimate upside scenario. But as an investor building long-term wealth, you cannot afford to be blinded by the upside.
No, you can't.
Critical thinking is essential here. We must evaluate the risk assessment, the bear case.
Absolutely. We have to keep this balance and look at the downside. The most glaring risk that you need to internalize is that AN2 Therapeutics currently has 0 approved products.
0.
All of this momentum, all of this institutional money is based entirely on clinical potential.
And that potential brings us to what we call the phase 2 cliff.
The cliff.
Clinical trials, especially in phase 2, are essentially the Shark Tank of drug development.
Yeah.
You can have brilliant lab data and a great pitch, but if the product doesn't work right there in human patients, the valuation plummets.
It's a binary event.
It's entirely binary. If the epetraborole phase 2 trial for polycythemia vera fails, if it misses its primary efficacy endpoints or shows unexpected toxicity, it could effectively erase a massive portion of the stock's value overnight.
Wow.
You have to remember they're carrying persistent $51.3 million net income losses. Without the promise of that oncology pipeline, those losses become a severe liability rather than a strategic investment.
And then there's the ongoing reality of dilution. We talked about the $40 million private placement at $2.85 per share being a positive for near-term liquidity.
Yes.
But the simple math is that it adds millions of new shares to the public float. More shares in existence inherently dilutes the equity of existing shareholders.
It does.
It also sets the stage for incredibly volatile price swings as the market digests the new supply of shares.
That is a very real headwind that you must factor into your timeline.
Yeah.
However, if we look at risk mitigation, the market seems to have already priced this dilution in.
How do we know that?
Because of the price action we dissected earlier. Despite millions of new shares being added to the float, the price experienced a 377% rebound, driven by those heavy institutional inflows.
You bought it up anyway.
The market absorbed the dilution because the trade-off is incredibly valuable. The cash runway is now completely secured for their near-term research and development. The existential threat of running out of cash tomorrow is essentially off the table, allowing the science the necessary time to play out.
So what does this all mean for your portfolio? Let's bring all these threads together for the final wealth-building thesis. When we evaluate the strong, defensible moat of their unique boron pipeline, the explosive technical rebound supported by volume, and the clear quantitative analyst upgrades offsetting the pre-revenue risks, this presents a highly compelling setup. We are giving this a final bullish score of 8 out of 10.
And here's the actionable elevator pitch for you as an investor. At $2.85, the stock is currently trading well below the consensus $3.50 price target set by analysts for 2026.
A nice gap there.
Because of the catalyst calendar we just mapped out, you have a really interesting dual horizon strategy available to you here.
Tell me about that.
You could approach this as a swing trade, strategically riding the immense volume and technical momentum into the upcoming Phase 2 clinical updates over the next 3 to 6 months. Or, given the rigorous institutional backing from heavyweights like Vivo Capital and GSK, you could view this as a multi-year hold. Accumulating shares at this level and waiting for actual drug approvals or a potential buyout to trigger a massive fundamental revaluation.
It is an asymmetric upside scenario that absolutely deserves your attention and a place on your watch list. But before we wrap up today, I want to leave you with a final provocative thought to mull over on your own as you research this space.
It's something I've been thinking about a lot. Consider the rapid evolution of artificial intelligence in drug discovery.
Okay.
We are seeing AI models map protein structures and simulate chemical interactions in seconds, tasks that used to take decades. Now, apply that to AN2 Therapeutics.
Right.
The pharmaceutical world struggled with boron chemistry for years because of its complex atomic behavior. But what happens when you feed a proprietary, stabilized boron framework into next-generation AI models?
Oh, wow.
Does AI suddenly unlock thousands of new boron-based compounds for diseases we currently consider incurable? The intersection of novel chemistry and artificial intelligence might just be the next great frontier in biotech wealth generation.
That is a fascinating angle to consider. A huge thank you for joining Smart Wealth with Joshua today. We hope this analysis helps you continue building your financial knowledge and navigating the markets with confidence. See you next time.